Urgent tone. The Philippine economy is currently suffocating under the heavy weight of sluggish macro growth, setting a tense stage for local corporate earnings. First quarter GDP dropped to just 2.8%, driven primarily by a severe and unexpected oil shock. Against this backdrop, let's look at Universal Robina Corporation, or URC. They are a local consumer giant whose snacks and beverages are a daily staple in millions of Filipino households. On the surface, their retail business is crushing it. Their first quarter sales actually climbed 6%, hitting a massive 47.9 billion pesos. Consumers are clearly still buying their branded foods. But here is where the math stops making sense. Despite that 47.9 billion in sales, core net income attributable to the parent company actually fell to 3.8 billion pesos. A company reporting record sales alongside shrinking profits challenges anyone following the headlines. Navigating this disconnect requires moving past the top-line numbers and into the operational fine print. To find out where the money is bleeding out, we have to separate vanity metrics from actual profitability, specifically the difference between top-line revenue and bottom-line net income. The green section highlights the good news. URC's branded consumer foods segment in the Philippines grew 10%, bringing in 22 billion pesos. As the chart shifts to operating income, reality sets in. The metric slipped 2% to 5.4 billion pesos, dragging overall financial health down. The margin squeeze developed within the sugar and renewables business, a segment that operates on a different set of economic rules than the snack aisle. The company is getting hit from two sides. Market selling prices for sugar have dropped, and distilleries are running at lower utilization rates. They are making less money on the raw commodity itself, while simultaneously operating less efficiently. A mountain of consumer sales offers no protection if your underlying commodity prices drop and operational inefficiencies bleed out your profit margins. And the internal bleeding is only half the problem. URC President and CEO Irwin Lee is actively warning investors about external cost pressures looming on the horizon. Lee specifically pointed to the geopolitical tensions in the Middle East, noting that any resulting inflationary spillover could severely disrupt their operating costs. If global energy and transport costs spike, that inflation gets passed down. It raises URC's expenses while shrinking the wallets of their customers, directly pressuring consumer demand in the upcoming quarters. The company is caught in a vice. They are dealing with falling commodity prices that hurt their internal revenue generation, while bracing for rising geopolitical inflation that threatens to crush their external demand. Given all of that grim fundamental data, you would expect URC's stock to plummet immediately after the earnings release. But it didn't. On the day the report dropped, despite the sluggish national GDP, the declining net income, and the looming inflation warnings, URC shares actually rose by 0.81%, to close at exactly 62 pesos. To understand why, look at this timeline showing a core concept. The stock market is a forward discounting mechanism. Current prices react to future projections. The market had already absorbed a poor first quarter before the report published. The bad news was already priced in. This is where the alpha protocol mindset comes in. Professional traders separate their emotional reactions from sensational news headlines, choosing instead to focus purely on clinical data. If you want to trade effectively, you have to update your Blackout Ledger. You prioritize the actual real-time price action happening on the charts over backward-looking earnings reports. Mastering the market requires prioritizing the actual price action shown on the chart. Are you buying the URC dip or avoiding the sugar crash?